So I got an article today. Norm Baker, Will Wealth Advisors. So I got an article today. Um, I heard it on a radio show. I can't give myself credit. Let me pull it up. It's the name of it is Retirement Success: A Surprise Looking into the Factors That Drive Positive Outcomes. Right. So a lot of times we're talking about what retirement. What do we need to do to essentially build wealth? Right, in our community, what do we need to do to build the wealth? Right. Um, what are the key factors? So this article, and it was written by ASPPA. What does that acronym stand for? Let's see if I can find it quickly. It is. I can't find the exact name of the full name of. I can't find the full name of it, but essentially it's a group of actuaries and retirement professionals, the ASPPA. And so anyway, they pulled together a article. Again, retirement success is surprisingly looking to the factors that drive positive outcomes. Now, the reason that I want to talk about this article is because a lot of people get bogged down in these kind of details. What are the details? Well, what drives it? Is it asset allocation? Asset allocation, what does that mean? That means, there's pretty much five major assets: stocks, bonds, real estate, cash, commodities. Stocks, bonds, real estate, cash, commodities. Those are the five, right? Those are the basic ones. Is the asset allocation is the balance between them. Do you have too much in stocks, too little in cash, too much in bonds, too little in commodities or real estate? So that's what that means. A lot of people talk about expense ratios. What does that mean? If you have a mutual fund, there's going to be a guy that he calls himself a fund manager, or a guy or a girl. They call themselves a fund manager. They run the mutual fund. The mutual fund has a number of stocks. We talked about this before. A number of stocks, and and they run the fund. Well, they get paid for that, right? So they get paid through what we call expense ratios. That's how much you're paying out of your fund for this guy to run it or girl to run it. People get caught up in a number of different things. So this article, and again, I'm pulling it up. This article talks it looks at um, a number of different 401k plans, a number of different companies. It says, hey, what really determines who succeeds in building wealth financially? And check this out. This is really interesting. So let's break down 1, 2, 3, 4. They have four different four different areas of what they would consider the components that make up what either makes people successful or not in investing. Asset quality, asset allocations, adequate savings, actuarial assessment. Okay. Just to break down each of those, asset quality is the quality of your mutual fund. You have a good mutual fund or a bad mutual fund. Is it performing or not? Asset allocation is what we talked about. Adequate savings is how much you're putting in. And actuarial assessment, that's essentially, are you getting help from an advisor, an actuary, professional help? Most people in the financial services business, in the actuarial business, anybody that has a fiduciary duty to their client financially, anybody, right? An advisor, a coach, anybody in the finance world, they spend most of their time on, from this article, asset quality and asset allocations. How do you pick the best mutual fund? And how much do you have in mutual funds versus bonds? This is really key. What they found is that asset quality is the least most important aspect of success. Meaning, of all the four categories: actuarial assessment, adequate savings, asset allocation, asset quality, picking the best mutual fund is the least most important thing you can do. The least most important thing you can do. Think about that for a minute, and we're going to dig into that. Next is actuarial assessment, the financial support that you're getting. That's second least most important. After that is asset allocation, bonds, stocks, real estate kind of thing. The most important piece, and this is key. This is so key. I want you to get this. The most important piece is adequate savings. How much you put in to your retirement slash 401k slash Roth IRA or IRA slash any investment vehicle or brokerage account. It's how much you're putting in. They're saying is the most. And here's another key to it. It's um, one of the least areas spent from folks in the financial world. The folks in the financial world are spending the least amount of time on how much you're putting in. They're spending the most amount of time on which mutual fund to pick. After that, allocation, the least amount of time, or one of the least amounts of time, and how much you put in. Mind blowing. Why is it mind blowing? Because it goes back to some of the things that we've talked about before. This is not rocket science. You don't have to have a bachelor's, an MBA, a PhD, a CMA, a CFA, what's the one for accountants? Um, CPA, CFP. Put money into your 401k. Put money into your retirement account. Put as much as you can in terms of what your budget allows, right? The age-old adage is 10%. You do 10%, you'll be fine, especially if you have a match. But if you do 10% anyway, over the long term, you'll be fine. If you do it and you make 50 grand a year, you'll be a millionaire. We'll touch on that in a second. But the key to this article, I wanted to hit on this article, is very important. Putting money in far is far more important than the mundane minutia details that folks get involved to on expense ratios and asset quality and doing one thing versus another, going with Vanguard as opposed to I don't know, what are some of the big guys out there? BlackRock and Vanguard and Fidelity. And put your money in. Put your money in and don't stop. Do it consistently, month after month after month after month, year after year after year after year. We went through the numbers last time. If you make $50,000 and you do this from age 30 to 65, or 20 to 55, or 40 to 75, you will be a millionaire. Think about that. A millionaire. It doesn't matter. It doesn't matter what you're putting it in. It matters to a degree, right? So, if you're going to do a mutual fund, you look at the prospectus and you look at the list and make sure these guys are competitive and you're close to what the market is doing, maybe above what the market is doing over a long-term period. But that's it. You don't need to spend more time on it than that. Asset allocation. As you grow in age, you want, really, when you get 10 years maybe outside of retirement, that's when you really want to kind of maybe tear back into some less volatile investments compared to stocks, right? You have bonds, you have cash, you have, other investments that are less volatile. Prior to that, stocks is where you're going to go. If you want to diversify into real estate or bonds, just from a diversification standpoint, fine. But to build the most wealth, you're going to go into stocks. So these are the concepts that I want to start getting across to people, because a lot of times you'll have financial snobs and they'll have conversations with you about, again, like we talked about, expense ratio, what's going on in the market, those kind of things. The average millionaire in this country built it in their 401k. It's that simple. That's proven. It's documented. The Automatic Millionaire, The Millionaire Next Door, read these books. This is documented. Random Walk Down Wall Street won't talk about the millionaire piece, but in general, this stuff is documented. They put it in their 401k. They kept putting money into the 401k consistently for years. That's it. There's nothing more to it. Now, How do you get money to put it in the 401k, right? You got to build a budget that makes sense. You have to document your spending. You have to tear down your debt. You have to increase your income through increasing your skill. Those are the things that we need to work on. But the building wealth part is easy. It's easy, guys. So that's what I wanted to hit. I wanted to, I'm really trying to drive that point, right? That we should, so think about this for a minute. Think about your group of friends or family members, right? Think of the closest 10 people you have around you. How many of them are millionaires today? How many of them do you know or you even think that they are millionaires today? 3 of them out of 10? 2? For me, it's probably closer to 0. 0. And I think for a lot of you, it's 0 too. Why is that? Because what I'm saying has not been taking place, right? It has not been taking place where we're putting money in to the market consistently, month after month, year after year, paycheck after paycheck for an extended period of time. It's not happening because the numbers historically support what I'm saying. It supports it. So if you don't know millionaires, it hasn't been happening. Why? Because we haven't been building budgets. We haven't been disciplined with our money. We haven't been focused, and we haven't been taught that we can build this. So the data is out there, the support is out there, and now people are really starting to talk about it in other articles and other scholarly pieces, as well as articles out by companies and institutions. So, willwealthadvisors.com. Look me up. We'll talk soon. And $50,000 over a 30-year period gets you saving 10% of it gets you $1 million. We got to build millionaires in our community. Bottom line, we got to build millionaires, and this is how we're going to do it. Peace.